Most Canadians go into retirement thinking, well, taxes are just a fact of life. There's no way around it. But here's the truth that very few people realize until it's too late. How you structure your income in retirement can be the difference between paying very little tax or handing over hundreds of thousands of dollars to the CRA. And here's the part that surprises the people the most. You don't have to be ultra wealthy to take advantage of this. Business owners, professionals, even diligent savers can often structure things so that in retirement, your tax bill is dramatically reduced. And in some years, you may not owe tax at all. Think about what that means. More money in your pocket, more flexibility in your spending, and a lot less stress about whether you'll outlive your money. So let's talk about how to do that. Hi, I'm Danny Perro, Senior Investment Advisor at CG Wealth Management. If you've saved and invested well, the last thing you want is to see a big part of your retirement wealth eroded by unnecessary taxes. The good news is, with the right planning, it's possible to structure your retirement income so that you stay in a low tax bracket and avoid clawbacks, and in some cases, even create years where you pay no tax at all. Today, I'm going to walk you through the main strategies that Canadians use to make this happen, step by step. If you find this valuable, don't forget to like, comment, and subscribe for more expert financial content. Tip number 1. The TFSA, your tax-free foundation, is the single most powerful tool for creating tax-free retirement income in Canada. That's right, every dollar inside a TFSA grows tax-free, and withdrawals are not taxable at all. Here's an example. Suppose a couple has each contributed to their TFSAs consistently since they were introduced. By their mid-60s, they could easily have $300,000 to $400,000 combined in TFSAs. In retirement, that money can be used strategically. If your RRIF withdrawal is going to push you close to an OAS clawback, you could take income from your TFSA instead. On your tax return, it doesn't even show up as income. That flexibility is what allows you to control your tax bracket year by year. Tip number 2, RRSPs to RRIF conversion. Don't wait until 71. RRSPs are a fantastic tool for tax deferral, but every dollar that comes out in retirement is fully taxable. If you just let your RRSP grow until age 71 and then convert to a RRIF, you're forced to start minimum withdrawals, and that can create a big tax spike. A smarter way is to approach it with what we call an RRSP meltdown. Between retirement age and 71, you might intentionally withdraw smaller amounts, even if you don't need them, and move that money into TFSAs or non-registered investments. Here's an example. Say you retire at 62 with $800,000 in your RRSPs. Instead of waiting, you draw out $40,000 per year from 62 to 70. You stay in a low tax bracket, and by the time you hit 71, your RRSP balance is smaller, so you're forced to withdraw less money also. This is how you smooth out taxes over time, instead of facing a big hit all at once. Number 3, corporate structures. Paying yourself efficiently for business owners. The corporation can be one of the best tools for tax efficiency. If you hold investments in your corporation, or if you sell your business, there are ways to blend salary, dividends, and capital gains to create a retirement income that's far more tax friendly. For example, I've seen business owners structure their withdrawals so their effective tax rate drops into the teens, and sometimes even close to zero for certain years. And if you plan early, you can even use things like the lifetime capital gains exemption on the sale of a qualifying business to shelter the significant chunk of those proceeds from tax. This kind of planning needs an advisor and accountant working together, and the results can be dramatic. Number 4, non-registered investments. Choose the right types of income, even in non-registered accounts. Not all income is created equal. Interest, for example, is fully taxable. Canadian dividends and capital gains get favorable tax treatment. So part of the planning for a low tax retirement is deciding which investments go into which accounts. For example, you might hold bonds or GICs inside your RRSP or RRIF, where the interest is sheltered, and use your non-registered accounts for investments that generate dividends and capital gains. That way, when you draw income from these non-registered accounts, it's taxed more lightly. Tip number 5, income layering. Combine taxable and non-taxable sources. Think of your income like building blocks. You don't have to take everything from one source. Let's say you need $90,000 a year to live on. You might take $50,000 from your RRIF and $30,000 from your TFSA, and then perhaps another $10,000 from a corporate account. On paper, you've only reported $50,000 of income, even though you've spent nearly $90,000. This is how you stay below that OAS clawback threshold and avoid higher tax bracket. The result? More income in your hands and less tax paid over the course of your retirement. Here's the big takeaway. Retiring tax-free, or as close to tax-free as possible, isn't luck. It's intentional. It happens when you start thinking about your retirement tax bill 5 to 10 years before you actually stop working. Most people think they'll just take money out of their RRSP or RRIF and call it a day. But that's when they realize their withdrawals are fully taxable. Their OAS is being clawed back, and their tax bill in retirement is almost as high as it was during their working years. With a plan, it doesn't have to be that way. You can draw from the right accounts at the right time. You can blend taxable and tax-free income sources. You can structure your withdrawals so that you can control how much tax you pay instead of the CRA. And the earlier you put these strategies into place, the more flexibility you'll have later. So let me leave you with this thought. Taxes will be one of your biggest lifetime expenses. Reducing that burden in retirement isn't just about keeping more money. It's about giving yourself freedom. Freedom to spend your time and your money on what really matters without worrying about a surprise tax bill waiting around the corner. If you want a second opinion on your plan, book a time with me using the link in the description below. I am Danny Perro, and remember, money never sleeps.